Good morning. Welcome. It is 6 a.m., half an hour before the market's going to open on February 12th, start of the week. So last week we had a really quiet week in terms of news. The market continued to move slowly higher, but the last couple of days it did start to trade sideways a little bit. This week we have the opposite. We have a whole bunch of news coming out, a few reports that are quite significant. So that on top of earnings, we have this week will be a heavy week of earnings. This week we start to taper down. So we do have a lot that can stimulate the market this week, and we'll see if we get a change in direction. Let me share my screen and take a look at the futures. Futures are insignificant, randomly down, almost nothing on the S&P 500, almost nothing on the NASDAQ, and then Dow is maybe 10 basis points, so a little over 10 basis points. So nothing to get excited about, not indicating much. This is one of those days where we can pretty reliably say that it might trade up. So about 70% chance of moving up if we open lower than the previous close. So we'll see if that holds true for today as well. But we're not really getting a lot of directionality out of the futures market. That's not too surprising because we have the CPI coming out tomorrow, and Mondays tend to be light on earnings. We'll check that really quickly, but we're not really expecting anything to move us around on today, on a Monday. So if we look at our earnings, let's go today before market. We only had one symbol. It's a $13 billion market cap, which isn't huge. So we're not really going to expect this particular day to be that active. We could get a lot of volatility tomorrow with the CPI report. That'll be really big. And then we've got PPI on Friday, retail sales on Thursday, industrial production, that'll be big. A couple of manufacturing indices, those will be less big, especially coming right before an industrial production report. So we do have some news items that could give us some volatility. Now, the S&P 500, the NASDAQ, all the major indices, they've been on this tear upwards and continuing this uptrend, and we're going to expect it to continue until we actually break. There are more and more signs of it slowing down. I've detailed them over the last couple of weeks, but it keeps on moving up. So we just have a couple more to pile on. And the more of these things pile on, the more likely is we're at the very least, we're going to get that pull back to this trend line very soon. And the more times we test this trend line, the more likely it is we're going to break it. So let's see what else we have that is indicating that we might be ending this amazing run up. Not to mention we are approaching that 25% move upwards. So one is the fear and greed index. We are back to extreme greed. We did slip down to greed a little bit, but now we're back at extreme greed, and there's only so long that we can stay in extreme greed. One of the very first market technicians, lived in the time of Jesse Livermore and was one of Jesse Livermore's contemporaries. They spoke a lot. They were both very well respected investors at the time, and he's considered the father of technical analysis. His name was Wyckoff. And he's the guy who some of you may have heard about the accumulation and distribution cycle in the markets. He's the guy who came up with that. So if we take a look at those cycles, and those cycles are based on supply and demand, and over the last few weeks, you've heard me talking about the warehouse analogy. So when we get to a place of extreme greed, that's when the public is in a frenzy to try to buy in. And that means the insiders and the market makers, they've been using the media to pump up everybody's emotions to get them really excited about the markets. And that's when the insiders, they start selling. Who can all these people who are extremely excited about the markets, who can they buy from? They buy it from the insiders, which means the insiders are selling. And so at a time of extreme greed, the insiders are selling. They're selling at the top. And that's what this is looking like. We're at a top. It looks like. We can't say for sure. What we have to see is it actually break, but there are a couple of indications that we're nearing the top, that the insiders' warehouses are full and they're starting to liquidate. And one of those things will be a volume and price mismatch, but there are other things that we could look at internally. So on top of the fear and greed index, I apologize, my mouth is really dry for some reason. But on top of the fear and greed index, we have our momentum levels. And we looked at this last week, and I identified financials as a potential opportunity. What I didn't do is a deeper look into the actual index, either the NASDAQ or the S&P 500 themselves. So let's do that. Let's look at that. So this does not look super extreme, although it is high. I have 69% of my stocks above their MA200, and I have 62% of my stocks at the S&P 500 above their MA50. So if I look at the MA200, it looks like we did reach a high. It's not a super extreme high like this one was, but we can see that over the last 10 years or over the last 20 years, we did not reach the 75% level that many times. And can we stay at or above the 75 level for a while? Yeah, we can stay for a few months, 4 or 5 months, but not super long. Not a year, not half a year, but a quarter or a little over a quarter. Yes, we can. We didn't stay up there. We started to trace back. So we start to see this downward movement in the MA200. That by itself, not too exciting. It could flip around and revisit this 75, maybe like this. Okay. So I'm not going to get too excited about this. Well, I want to check the MA50, see if I have a different story or similar story. And that story is very different. We hit almost 90. There's in the last 20 years or so, since 2007, almost 20 years, we've only been up here 1, 2, 3, 4, 5. This was the 6th time. And every time we only stayed up there for not even a month. And that's what happened this time. Now we're down all the way at 61.8. So I see this momentum drop in the MA50s. So if this continues to slide downward, then the index, the S&P 500 itself, can't stay up there that long. And then we'll start to see at least a little bit more of a drop in the MA200. So this is a sign of it topping out as well. The fact that my MA50s are starting to slip down, and when we reach these peaks, where do we tend to fall? 40 something, 30, 28, 37, 20. Okay, within 1, 2, 3 months. Okay, so in the next couple months, I can expect this to come low, which would indicate that most likely we're talking about a correction, not or at least a 5% pullback, not a 2 or 3% pullback. So this is implying over the next couple of weeks or months that we could get that correction and pullback that we've been talking about. And there are other indicators that we've been looking at that indicate it might be a little bit sooner than that. Another thing that I was looking at over the weekend was the number of 90-day highs. We have 309 stocks hitting their 90-day highs, and on the 90-day lows, we only have 15. That's an extreme discrepancy. And maybe a couple months ago, you may have heard me say something like, when we get to extremes, when we get 300, 400, 500 stocks hitting a 90-day high or 90-day low, we tend to start flipping around. So we got more and more signs that we're going to start pulling back, at the very least, to this trend line and then potentially break. So let's see the last time we had a break of a major trend. And I want to see what the signs were. Oops. And see if I can find it. What I'm looking for is a doji or a hammer that indicates a supply change. So this one is a doji near the top with a low volume. So that's an indicator of a flip. And then this one is a stronger indicator because we tried to trade up and we failed and we came back down on low volume. So that's a sign of liquidation. Actually, it's not a sign of liquidation. It's a sign that the market makers are testing the market. And they want to say, hey, if I make it go down, do I get a large volume of buyers? Okay. So for example, this one, no real good examples right here. It's harder on the S&P 500 because it's the overall markets. There's not one market maker. It's all the market makers. But we should still be able to see indications of this. So that's the one we were just talking about. So if I have a large volume and a large price movement, that's indicators that there's still buyers over here. Even though we had the down day, there's still buyers. The next day, more buying came in. The next day, more buying came in. And then we had the test again. So what'll happen? You just think, if you are familiar with marketing or you're familiar with especially online marketing, what they do is, if I'm getting ready to do a campaign and I have a marketing budget and a certain percent of that marketing budget goes to an advertisement, I don't spend my entire budget on the advertisement. What I do is I do what is called an A/B test, where I put out one ad and I put out another ad, or I put out one price and I put out another price. And I test the market and I see how well they perform. How many people buy at $100? How many people buy at $90? How many people buy at $70? And which one ends up being more profitable? If I get 5 transactions at 100, I made $500. If I get 10 transactions at $70, I made $700. Okay, I made more money with the $70 price point. I'm going to go with that. Okay. And then I start pumping more and more money into it. I look for that advertisement that starts to perform. Maybe I have 3 or 4 different advertisements at the $70 price point. And then one of the ads will perform better than the others. And then I start pouring more and more money into that advertisement. And when that advertisement stops performing, then I go to the second best advertisement and start pouring more and more money into that. And then when that one stops, then I go to the third until I can't sell anymore. I start running out of inventory or my production can't keep up, something like that. So the financial world is not different. It is a consumer market as well. And insiders will behave the exact same way. If I'm the market maker for Microsoft, what I do is I will test the market. I will say, hey, I want to start clearing out my inventory. So I want to sell at the best prices that I can. And I'm going to start selling. But the worst thing that can happen to me is I start selling and a huge surge of buying comes up and it takes it beyond where I wanted it to go. So that was the wrong way. I start buying, like I'm out of inventory and I start buying. The worst thing that I can do is other buyers come in and bid up the price. So what I do is I test. I throw out a test, and if there's not a big response, I get low volume and low price movement, then I know that there's no other buyers out there. I scared everyone off because I'm getting confused because I'm looking at this uptrend, but I'm talking about the bottom. So I should be looking at a time where we're coming down. And so I'm trying to buy, I'm trying to accumulate my stocks back up. And I don't want other buyers to come in and drive the price up. And so when we see this consolidation period, then the insiders are trying to buy down here in this region. It doesn't, this range of prices is okay because they have hundreds of millions or billions of dollars that they're trying to spend. So they don't care about a specific low price, they care about a range of prices. As long as we don't blow through it like this, then they're okay. So they don't want this to happen until they're done buying, they're out of cash. So they throw out little tests and say, well, are other people going to come in? Oh no, well, it didn't happen over here because people are still traumatized by this drop. And then maybe because the insiders are buying, we come up a little bit and then it starts to come back down because what are we doing? We're trying to shake out the people who are still hanging on to their inventory or hanging on to their stocks so that the insider can build up its inventory. And we throw out little tests to see if people are going to buy. People are going to buy. Or when people are not buying, then that's a successful test. And what that means is that there's no one else to sell. There's no one else for the insider to buy from. And now they can start influencing the market to move higher or utilize natural things that are happening in the news. Oh, Microsoft just announced their new AI, whatever. And then people start to get interested in it. The market makers sitting on a whole bunch of inventory and they're just watching this go up. So something happened right here. There might have been another accumulation phase right here where the market maker is like, okay, well, I sold some on the way in order to help this go up and I'm rebuilding my inventory. And then we started to go up again. Now, by the time we've moved 25% or more, well, that's in the overall market. So individual stocks will have different amounts. So this one's 35% already. So different individual stocks will have a different percentage that they tend to move up for and then indicate that all the market makers are full. But let's just pretend that 35% is the number for Microsoft. Now they're going to start looking to distribute. And when they distribute, you're going to see sideways movement as they're getting rid of all their inventory because they don't want it to crash while they still have inventory. And that's why we tend to have these consolidation periods. So we might start seeing some consolidation. And we started to see it a little bit in the S&P 500 where we have these baby sideways movements, but buyers are still here. Buyers are still here. So buyers being here is not a problem for the market makers, but what'll happen is it doesn't have to necessarily go, it can look like this. So it'll bounce around sideways for a while and then it'll come down. So it's just looking more and more like that we're there. So we're not going to expect a hammer or doji candle with low volume to indicate a break of trend. What we will want to see is after we've had a period of consolidation, then we see it, then we might get that break of trend and that movement downwards. In any case, I went through all that explanation just to say it was looking like we are entering a period where we might start moving sideways. That's also indicated over the last several weeks. We've been flip-flopping tech, staples, tech, staples, tech, staples, tech, staples. And this week it's tech, or last week it was tech again. So this week we'll see if we pull back into staples, we'll know that that's an internal indicator that we're actually starting to move sideways, and this upward trend is weakening. So we're going to be very careful. Exact same. I've been repeating myself. I feel like a broken record. We have an uptrend. Our portfolios are pointed upwards. And we want to make sure we're hedged because we don't know when this thing is going to break. It's unlikely to just break. It's more likely to move sideways for a period and then break down. So if you're not perfectly hedged or you don't have hedges, you're probably okay for a while. We just want to be aware that there's this potential that we're approaching this time period where we might pull back to the trend line. We might crack through it a little bit. We might go down 5%, and then we might consolidate our momentum on the MA50s indicated in the next 1 to 2 months. We might start moving downwards. So we have a 1 or 2 month period where maybe we'll start consolidating and then we start moving downwards. But we'll be watching for signs, like more distinct signs, like the price and volume action that I talked about, that before we get the actual correction. Remember, we expect one correction of about 10% every year on average, and 2 to 3 of pullbacks of about 5% every single year on average. This year, so far, we're only 1.5 months into it, but it's been nothing but up. We haven't had a 5% correction. We haven't had a 10% or 5% pullback or 10% correction. So we're looking for our first one this year at sometime somewhat soon. Okay, I've been talking for way longer than I expected to, and we have less than 10 minutes before the market open. So we'll end it there, and then we can carry on any further discussion, or if anything exciting actually happens during this session against expectation, then we'll talk about it in the after session. Have a wonderful day. I'll see you after the markets.